Hi there, welcome to Nappy Invest. Someone mentioned the other day that Harvey Norman is one of the highest quality retail companies on the ASX. I think it was Scott Phillips. I think he might have been on the core show on AusBiz. And when he said Harvey Norman, my ears perked up a little bit. So I thought I'd do a little bit of research on Harvey Norman. And I probably would have to disagree with him a little bit. I don't think this is one of the highest quality retail companies on the ASX. And there are a few reasons behind that. I'll talk about those reasons later in the video. But when the company did release the half-year results, the share price was down at one point in time, 10%. There was a little bit of buying late in the day, and that pushed the share price up. And I think the share price at the end of trading on February the 28th was down about 7.5%. So let's have a look to see why the market punished Harvey Norman on February the 28th when the company released the half-year results. In just preparing for this video, I did learn quite a bit about Harvey Norman. One of the things I learned about this company is they are way more global than I thought they were. I knew they had stores in Asia. I did not know they had stores in Europe, including Croatia. In fact, they'll have stores in Hungary in calendar year 2024. They also have stores in Ireland, maybe even the UK as well. Anyway, these are the financial year, the first half, financial year 23 results. Not the biggest fan of the way they presented the results in the announcements they did release to the market. So about 3 or 4 announcements, including the presentation, the financial statements, also a media release. So in this particular slide, we're looking at the EBITDA, profit before tax, profit after tax, and net assets over the last 4 first half years. So we're talking about, or including here, the half year just before COVID-19. And for some reason, a lot of companies want to compare the current half year, so the first half of financial year 23, to the first half of financial year 20. So they want to compare pre-COVID to post-COVID. And I know why they're doing that, because the numbers look really good. For instance, Harvey Norman's EBITDA, 3-year compound annual growth rate in that has been 16.1%. Profit after tax has been increasing at 19.7% per year since the first half of financial year 20. But I don't think you can compare the 2 half years. We're still in a COVID-19 affected cycle right now. Maybe not cycle, but period right now. And we are still experiencing heightened retail. So I don't think you can exactly compare that pre-COVID half year to this current half year, but I understand why they are doing it. The main thing here is all these metrics, apart from net assets, have been falling over the last 3 first half years. So the first half of financial year 21 was by far the best half year this company has experienced over the last 4 half years, for last 4 first half years. Harvey Norman also gave us a trading update comparing their retail sales in January 2023 versus January 2022, and these are not good numbers. So they compared the sales in the different geographic areas. So you can just see how their different locations are performing throughout the world. And yeah, again, these are not pretty numbers. For example, Australian franchisees, sales down 10.2%. New Zealand, sales down 8.1%. Northern Ireland, not sure what's happening there for Harvey Norman, sales down 27.2%. Singapore, sales down 10%. Malaysia, sales down 5.5%. Now, one thing they've done here is they're comparing total sales with something called comparable. I'm assuming here, because they didn't give us any definition what comparable means, I'm assuming that's like for like. And like for like just means if the company didn't open up any stores, these would be the increase or decrease in sales. Obviously, they opened up some stores in Ireland because total sales was 4.9%, but comparable sales down 0.1%. But for some reason, Harvey Norman is doing spectacularly well in Slovenia and Croatia. Sales up 10% for January 2023. Not sure what's happening there. Not sure why there's an increase in sales in those 2 countries when the rest of their stores throughout the world, sales are going down in the opposite direction. Now to some financial metrics that are important for me and my investing style. I use these all the time. One of these I started to use more than I have in the past. That's return on invested capital. I started to use that over return on equity because I do think it's a little bit more powerful. But this video is not on return on invested capital or return on equity and the differences between those two. So I'll stop rambling on right now. But I do look at these financial metrics a lot for every single company. But there is one financial metric or financial number we need to be aware of when we are researching a company, and that's the markup or the valuation. In fact, that should always be the first step when you're valuing a company, or maybe it should be the last step. So maybe you could value the company and then compare their value to the current market and then decide whether the company is overvalued or undervalued. So either the first step or maybe the last step is looking at the market cap or the valuation of a company. For Harvey Norman, the market cap is currently at $4.7 billion. That's a share price of $3.70. Of course, we all should know, hopefully you all know, that share price is fluid. It changes from day to day. So if you are watching this video, say March the 28th, 1 month after I have recorded this video, the share price could be significantly different, higher or lower than $3.70, which means the market is going to be higher or lower than $4.7 billion. Now on to the profit and operating cash flow. I'm using financial year 22 numbers here. Sometimes I would use trailing 12 months, which is the most recent half year added with the second most recent half year. So for Harvey Norman, it would have been the first half of financial year 23 and the second half of financial year 22. And those numbers for trailing 12 months would have been lower than the financial year 22 numbers Harvey Norman did report. And those numbers are profit, 831 million, operating cash flow, 660 million. Now, the reported operating cash flow that Harvey Norman would have had in their financial statements is going to be higher than 660 million because I always include lease liabilities. That's just the way I look at operating cash flow, because in my opinion, if you are leasing out a store, that cost is a part of operations, but accountants think differently, and more than likely accountants are right and I'm completely wrong. But I just like to look at leases because that is a cost of doing business. Just my opinion. Now, revenue is very important to me. I want to invest in companies that have revenue growth. And I look at different periods here. So I look at 10 years, 5 years, 3 years. Also look at trailing 12 months as well, but I haven't included trailing 12 months in this particular slide. But Harvey Norman has consistent revenue growth. So over the last 10 years, revenue has been growing at 5% per year. Over the last 5 years, 7.1%. Over the last 3 years, 7.2%. Not every year the company will have revenue growth. There will be some years Harvey Norman has negative revenue growth. Some years the company has revenue growth above 10%. And more than likely, revenue growth in financial year 23 will be negative for this company. But the main thing here is revenue growth for Harvey Norman sits between 5 and about 7.5%. Typically, I want to see these three numbers above 10%. And that's the first reason I don't or would not consider Harvey Norman to be one of the highest quality retail companies on the ASX. So I would disagree with Scott Phillips on that argument. And that's one of the arguments I would have against that. Another argument I have against Harvey Norman being one of the highest quality retail companies on the ASX is around return on invested capital. So I would, in the past, use or look at return on equity, return on assets, those sort of things. But I am now leaning more towards looking at return on invested capital because of research I have done over the past few months. And I find there is a really good correlation between a return on invested capital and performance of a company, financial performance and share price performance. So I'm looking at return on invested capital being above 10. And typically, and what I'm finding in my research, a lot of times you will see fairly similar return on invested capital number, so 8.4 for Harvey Norman, and revenue growth and share price growth as well. So the revenue growth for this company sits between about 5 and 7.5%. Return on invested capital in financial year 22 was 8.4. But historically, over the past 10 years, return on invested capital for Harvey Norman is usually between 5 and about 7, which is very similar than their revenue growth. And I'm finding this correlation a lot out there. In most companies I do research on, a really good correlation between return on invested capital and the share price and revenue and profit performance of a company. Now, and maybe I'll do a video on that in the future, return on invested capital, because it does seem like a very important valuation metric or financial metric Some people look at return on equity, but I am finding that return on invested capital is a little bit more powerful than return on equity, but I'm rambling on now. So let's go to the valuation metrics. So a lot of investors look at P ratio. Some investors might even look at price to operating cash flow, and a P ratio of 5.7 looks really, really small. Even a price operating cash flow of 7.1 looks really, really small. So the market is obviously expecting earnings to decrease over the next few years, maybe just in financial year 23, maybe in financial year 24. But if profit halves in financial year 23, the P ratio for Harvey Norman would be 11.4, which doesn't seem that high. And maybe even historically wouldn't be that high. So possibly you could argue right now there is some value in Harvey Norman. And I think that's one of the reasons why there was a little bit of buying today, particularly in the afternoon. So there would have been some investors who saw the share price down 10% and thought this is a bargain at these valuations. Now onto the long-term chart for Harvey Norman. This is the weekly chart going back to the start of 2016. So a 7-year chart. The reason I didn't go back further and look at the 10-year chart is because between about 2012 and 2017, share price of this company was in a really nice uptrend. So that would have been a great time to own shares in Harvey Norman. If you bought shares in 2016, you would have seen the share price go sideways. Since then, there would have been good periods of time when the share price was higher. There would have been bad periods of time when the share price was lower than when you bought. But it seems like when the share price gets below about $3.50, that's a good time to buy some shares in Harvey Norman. And when the share price gets above about $5, $5.50, that's maybe the time to decrease your holding in this company. So at this point in time, over the past 7 years, the share price of Harvey Norman has gone absolutely sideways. If you take away the volatility, it's gone absolutely sideways. In fact, the share price has decreased a little bit after this bit of a sell-off on February the 28th. That's all I have for this Harvey Norman look at their half-year results. Even though I've got here share price down 10%, there was a nice little rebound in the afternoon. So the share price only down about 7.5%. So maybe the market is seeing some value in Harvey Norman at the current share price, current valuation with a P ratio of 5.7. But be aware, the market is expecting earnings to decrease significantly in financial year 23, because if earnings don't decrease significantly in financial year 23, Harvey Norman at current prices is an absolute bargain. If you have any questions about Harvey Norman or anything I've mentioned in this video, I'd love to hear your questions, your thoughts. So leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.